Most people think tariffs are just about prices at the checkout counter. A few dollars more for a phone, a slightly higher grocery bill. But that's not where the real cost shows up. The real cost hides in a place most Americans never look: the US Treasury market, the invisible backbone of mortgages, car loans, government power, and America's global influence. When tariffs rise, they don't just tax imports. They quietly reshape deficits. They change how many bonds the government must sell. They alter who is willing to buy America's debt and at what price. And when that balance shifts, long-term interest rates move, sometimes fast, sometimes violently. If you've felt borrowing getting tighter, if you've wondered why markets react so sharply to trade headlines, there's a deeper system at work. Stay with me, because once you see how trade policy collides with treasuries, you'll never hear the word tariff the same way again. And to understand why this matters now, we have to define the real problem hiding beneath the politics. Most debates about tariffs focus on who pays: consumers or foreign exporters, workers or corporations. That framing misses the real fault line. The deeper issue is financing. The United States is running a budget deficit near historic highs outside of crisis periods. That gap has to be funded, not with rhetoric, but with debt. Every year, Washington sells trillions of dollars of US Treasury bonds to cover the difference between what it spends and what it collects. Those bonds set the baseline for interest rates across the entire economy. Here's where tariffs quietly enter the story. Tariffs generate revenue. That revenue can slightly reduce how many bonds the government needs to issue. Less supply, all else equal, can ease pressure on long-term yields. But tariffs also inject uncertainty, legal, political, and economic. And bond markets price uncertainty relentlessly. So the real question isn't whether tariffs are tough or fair. It's whether they stabilize or destabilize the market that finances American power. To see how we reach this fragile balance, we need to step back and look at how deficits, debt, and trade collided over time. For decades, the US could run deficits without panic. Global demand for treasuries was deep, automatic, almost taken for granted. From the 1,980 seconds through the pre-pandemic years, deficits averaged far lower than today. Bond issuance grew, but demand grew alongside it. Foreign governments recycled trade surpluses into US debt. Banks treated treasuries as pristine collateral. The Federal Reserve became an occasional but powerful buyer in moments of stress. That balance began to shift after COVID. Deficits widened structurally, not temporarily. Debt issuance accelerated into a market that was no longer expanding as effortlessly as before. At the same time, trade policy changed character. Tariffs stopped being narrowly targeted tools. They became broad fiscal instruments, sources of revenue, leverage, and political signaling. That combination matters, because when deficits grow faster than reliable demand, the system becomes sensitive. Small policy changes start to move long-term yields. Legal uncertainty starts to matter. Timing starts to matter. This is the backdrop against which today's tariff strategy operates. Not in a stable world, but in a finely balanced one. And that balance has already cracked once before. Quietly, but dramatically, that moment came sooner than most people remember. The warning shot came in 2023. And it didn't start with a recession. It started with an announcement. That summer, the Treasury Department revealed it would need to issue far more debt than markets expected. The reason was simple. Deficits were larger, and funding them was becoming harder. Investors reacted instantly. A major credit rating agency downgraded US debt. The term premium, the extra return demanded for holding long-term bonds, jumped. Within weeks, the 10-year Treasury yield surged toward 5%. Equity markets slid. Borrowing costs tightened across the economy. Nothing had broken, but something had shifted. That episode exposed a new reality. Bond markets were no longer indifferent to supply surprises. They were hypersensitive. Now layer tariffs on top of that fragility. Tariffs bring revenue but also legal risk, court rulings, policy reversals, sudden gaps between expected and actual bond issuance. Every one of those forces feeds volatility. And volatility is poison for long-term financing. If you care about mortgage rates, if you care about market stability, if you care about economic confidence, this isn't abstract. And the real danger isn't just supply, it's who shows up to buy. That's where the next crack begins to form. For years, the Treasury market relied on a dependable trio of buyers: the Federal Reserve, US banks, and foreign governments. They weren't chasing yield. They were chasing stability, liquidity, systemic safety, but that structure has changed. Today, those traditional buyers account for a much smaller share of the market than they once did. Quantitative easing is fading into the past. Banks face balance sheet constraints. And foreign investors are no longer automatic buyers at the margin. This is where tariffs intersect with demand in a subtler way. Trade relationships shape reserve behavior. Countries that sell heavily into the US tend to hold dollars, and those dollars often end up in treasuries. But when trade becomes more confrontational, more fragmented, that loop weakens. Not abruptly, gradually. Central banks don't dump bonds on headlines. They let them mature. They reinvest a little less each time, quietly reducing exposure without triggering panic. At the same time, new buyers are being invited in. Stable coins, short-term instruments, innovative but fragile sources of demand that concentrate risk at the front end of the yield curve. The system still works, for now, but its resilience depends on confidence. And confidence depends on growth, inflation, and the central bank's next move. That's where trade policy delivers its most powerful and dangerous shock. The second shock doesn't come from Washington. It comes from expectations. When sweeping tariffs were announced, markets didn't wait for the data. They repriced the future. Growth expectations softened. Inflation expectations moved the other way, up. That combination is toxic for bond markets. Slower growth means deficits linger. Higher inflation means investors demand more compensation to hold long-term debt. The result was immediate. The yield curve steepened sharply. Long-term yields jumped in a matter of days. This wasn't about panic selling. It was about recalibration. Tariffs raise the risk of sticky goods inflation. They invite retaliation. They distort supply chains that took decades to optimize. And when inflation proves stubborn, central banks hesitate. Rate cuts get delayed. Policy stays tighter than markets expect. That feeds directly into the term premium. The invisible surcharge investors add for uncertainty. In this environment, even a small policy shock can echo loudly. A court ruling, a trade escalation, a surprise fiscal bill, nothing collapses, but everything tightens, which brings this story out of markets and into real life. Because when yields move, they don't stay on trading screens. They land somewhere much closer to you. When bond yields rise, the effects ripple through the economy. You don't just feel it on Wall Street. You feel it when you try to borrow for a house, a car, or a business. Long-term interest rates set by Treasury yields become the baseline for everything. Your mortgage rate? It's tied directly to the 10-year Treasury yield. Your auto loan? Same thing. The problem is that when Treasury yields climb, borrowing costs soar. And when borrowing costs rise, consumer sentiment falls. People spend less. They hold back on big purchases. They delay investments in their future. The economy slows. On the government side, the cost of servicing debt becomes a heavy burden. The US spends more on interest than ever before. That eats into money that could be spent on infrastructure, healthcare, or education. Instead, it flows into bondholders' pockets. That's the danger of rising yields. They don't just tighten the screws on markets, they choke the lifeblood of the economy. And here's the kicker. When tariffs push up yields, they don't just hurt American households, they hurt America's power globally. The US has a unique advantage. Its debt is the world's most coveted asset. But when yields rise unchecked, the cost of US borrowing rises for everyone. That's a problem not just for Americans, but for the global financial system. The stakes are high, and they're growing higher by the day. As we look ahead, the next few years will reveal how far-reaching these shifts in trade policy go. The question isn't just about whether tariffs will stay at these levels. It's about what they leave behind. The most pressing concern is the long-term supply of US debt. The US government needs to issue trillions more in bonds to fund growing deficits. But as we've seen, demand for those bonds is becoming more unpredictable. Foreign investors, once the bedrock of the market, are diversifying away from the dollar. New buyers like stablecoins introduce both opportunities and risks. The result? Higher risk of long-term treasury volatility. A mismatch between supply and demand could lead to higher long-term yields. That would push borrowing costs even higher, squeezing both consumers and the government. But this isn't all bad news. There are steps that policymakers can take to protect the treasury market. It's possible to reduce tariffs on non-strategic goods, helping lower inflation and easing fiscal strain. At the same time, a focus on fiscal sustainability, including Social Security and entitlement reforms, would signal to investors that the US is serious about its long-term economic health. The next move is crucial, because the choice between protecting the treasury market and protecting trade interests will define how the US competes and borrows in the decades to come. The truth is, we are at a crossroads. Trade policy and treasury policy are no longer separate worlds. What happens in one realm directly impacts the other. And as the US navigates its path forward, the consequences of each policy choice will echo far beyond its borders. The tariff-driven revenue surge, it's not a permanent fix. It's a band-aid that covers deeper fiscal wounds. The risk of a legal backlash or changing administrations looms large. And even if tariffs hold steady, their broader impact on the global economy is already beginning to take shape. The US must adjust, not just to the pressures of a globalized world, but to the changing dynamics of bond markets. By prioritizing strategic tariff reductions, understanding the risks of new buyers like stablecoins, and strengthening fiscal responsibility, policymakers can stabilize the treasury market. But that's a narrow window. If these issues aren't addressed, we'll see long-term yields rise, squeezing consumers and businesses alike. That ripple effect will stretch from Main Street to Wall Street and to the far corners of the globe. The next chapter is unwritten, but its foundation is being laid right now. The future of the US Treasury market and its place in the global financial system depends on the decisions we make today. The political and economic landscapes we're navigating today will have lasting consequences, not just for America's financial system, but for the world at large. Trade policies that seemed like tactical maneuvers during the Trump administration are now part of a larger, complex framework, one that intertwines with US debt, treasury yields, and the future stability of the global economy. But here's the critical truth. The US Treasury market, once an untouchable pillar of global finance, is under strain. The rise in tariff-driven revenue won't last forever. Changes in international trade dynamics and shifting investment patterns threaten to create long-term volatility in an already precarious system. The long-term solution lies in policy adaptation. Policymakers must work to reduce tariffs on non-essential goods, boost fiscal discipline, and address the structural vulnerabilities in the treasury market. Only then can they stabilize the bond market and keep US debt attractive to the rest of the world. The future isn't guaranteed, but the path we choose to take in the next few years will shape global economic trends for generations to come. It's time for Washington to act before the bond market acts first. As we close this chapter on the intersection of tariffs and treasuries, the next few years will be pivotal in shaping the global economic order. The dynamics we've explored, the rise in tariffs, the expansion of US debt, and the changing nature of bond demand are setting the stage for critical decisions. But there's a larger question at play. What does the future hold for the US economy, and how will the world respond to these shifts? Three potential outcomes loom ahead. Optimistic scenario. Trade policies recalibrated, tariffs are reduced on non-essential goods, creating room for lower inflation and more fiscal flexibility. The US Treasury market stabilizes as both domestic and foreign demand remain strong. The economy finds a path forward, with borrowing costs staying manageable and consumer sentiment improving. Neutral scenario. Trade policy remains inconsistent, tariffs stay in place, but uncertainty leads to sporadic market fluctuations. The Treasury market experiences intermittent volatility, but no catastrophic collapse. US debt continues to grow, but the impact on long-term yields remains relatively contained. Global investors remain cautious, but still view treasuries as a safe haven. Pessimistic scenario. Trade wars escalate, tariffs continue to rise, and global demand for US debt wanes. The Treasury market faces significant stress, pushing yields higher and straining both consumer and government spending. Confidence in the US dollar erodes, leading to a potential reevaluation of America's role in the global financial system. In the end, the future of treasuries hinges on policy choices made today. The ability to manage debt, stabilize trade relations, and maintain fiscal discipline will determine whether the US continues to enjoy its position as the world's economic leader or whether new dynamics push it from its perch. The clock is ticking. What comes next could be the most significant economic pivot in decades.